So I'm going to spend the next hour or so talking about the developments in the container shipping market. Uh, the container shipping market has been the hottest shipping segment for the last 5 years. And if you look at this chart here, you can see why. Because for the last 5 years, since 2020, the container shipping market has enjoyed a massive super cycle. And what is remarkable about the cycle that we are currently in, the first feature of this is the extent of the peak of this current cycle. It is in terms of multiples, more than 10 times higher compared to any previous cycle that this sector has ever seen. Now, if you take the combined earnings of the shipping companies in this last 5 years, it more than exceeds the cumulative earnings of the last 50 years in this industry itself. So it's extremely high peaks that have never been seen before. But there's also a second feature about this current cycle, which is quite unusual, and that is the duration that this cycle currently has taken. Because we are now into our 5th year of this high earnings cycle. And in this case, I've combined the last 2 cycles and treat that as one because at this point, the shipping lines in this sector is still enjoying extremely high earnings. And this is quite unusual given the fact that historically, the shipping cycles, not just in container shipping, but in most other shipping segments, typically last from 3 to 4 years. Now, what is unusual this time is that we are already into our 5th year of this cycle, and what's driving this time is very different from all previous cycles that the market has faced. And the reason for that is it's driven by external events. The first COVID cycle clearly was driven by the pandemic, which caused an elevated hike in demand, especially for consumer goods around the world. And that cycle itself came to an end in 2023. But what has helped the market recover from that COVID cycle is the start of the Red Sea crisis. And that started at the end of 2023. And that has again caused a massive imbalance in the market that's driven by excess demand over supply. And that has, at this point, continued to support the cycle, and we are into the 5th year of this. Now, if you look at the earnings, the EBIT margins that the container shipping companies have earned, again, you can see this clearly illustrating the extent and the duration of the current super cycle that I've just mentioned. At the peak of the COVID pandemic, the shipping lines were earning EBIT margins in excess of 50%. And if you compare that against the historical average, the container shipping lines historically have failed to cover its own cost of capital, because if you look at the average EBIT earnings of the shipping companies historically, the average was less than 5%. And compare that against what they've been earning. And even though at this point, if you look at the most recent results of the shipping lines, it's quite clear that we're coming to the tail end of this current cycle. But even with the reduced earnings that we're seeing in the second quarter this year, it remains significantly higher than the historical average. Now, of course, what's happened in this last 5 years is already past. What is the more interesting question at this point is what happens as we move forward, especially given the uncertain trade environment that we're currently facing. Now, before we get into that, I just also want to point out that if you compare the earnings of the shipping lines in this sector right now, if you look at the top 10 publicly traded shipping companies, again, these are the EBIT margins that these individual companies have been earning. What is remarkable about this is that there is a significant gap between the top and bottom performers at this point. So if you take the second quarter average earning margin at about 10% right now, we haven't gotten all of the company's results out yet. But certainly if you look at those that have already published their second quarter results, again, you will see that the gap between the top performer and the bottom performer at this point has remained extremely large. If you look at the top performer right now, the Asian carriers have tended to overperform compared to their European counterparts. And what is quite remarkable is to look at the top performer right now, which is One High. Their margin in the last quarter remains at above 20%. And if you compare that against the largest European name in this list here, Maersk's EBIT margin is, by comparison, extremely poor at less than 3% at this point. Now, what does this point to? I think it does reflect for right now the resilience of the Asian operators, especially those that have a larger exposure on the intra-Asian market. And certainly if you look at the names in this list, the Asian names for the last 5 years have tended to outperform the competitors from the other parts of the world. And part of the driver behind this, apart from the intra-Asia trade strength, is that the Asian carriers tend to have a larger focus on the Trans-Pacific, meaning the Asia to US trade lane, compared to their European counterparts that tend to have a larger exposure in Europe. And the Trans-Pacific trade has been the key and most profitable trade lane for many of these companies. And that also partly explains why the Asian carriers have tended to outperform. Now, the problem with that is that given the uncertainties that's driven by the Trump tariffs, what is going to happen as we move forward on this? And again, before I touch on that, I just want to point out one of the key reasons for the underperformance of the Europeans is their lack of focus. And that is clearly illustrated by the performance of Maersk Line. Now, for those of you who are familiar with this sector in more detail, Maersk Line, until 5 years ago, was the largest container shipping company in the world. But why is it underperforming so poorly at this stage? You can see since 2017, Maersk has shifted its focus away from container shipping into a new strategy, which they call the logistics integrator strategy. The problem with that strategy is that it is simply not working for them. Now, if you look at their 3 key business segments, which is container shipping, logistics, and terminals, meaning the port operations. Again, you can see that the container shipping sector at the height of this current cycle was earning a return on capital that was more than 100%, meaning for every dollar that you put in the business, you earn that back in less than a year. Unfortunately, Maersk have failed to grow this most profitable part of their business. And instead, it has chosen to refocus their business strategy in the logistics segment. And you can see that in terms of their capital investment, they have allocated more than $10 billion in growing their logistics segment. within this last 5 years. And one of the largest acquisitions they made was the acquisition of Li and Fung, which is based in Hong Kong. Now, the problem with that strategy is that if you look at the rate of return on invested capital, the logistics segment on average has earned below their own cost of capital. If you look at the average earnings of the logistics sector, it remains at less than 6%. And if you compare that against the earnings that the container segment has been able to enjoy, it clearly pales in comparison. Now, the other sector, which is very interesting here, especially in the context of a major upcoming IPO in Malaysia, which is for MMC, you will see that the container port segment has been the most stable and consistent segment. And in terms of returns, it is comparatively attractive, especially when you compare that to their logistics business. Because if you look at the rate of return on port investments, it is close to 20%. And the other remarkable thing is how steady the returns on the terminal sector has been, relative to the significant volatility that you're seeing on the ocean side of the business. Now, again, the key question is what's going to happen as we move forward, given that we are already at the tail end of this super cycle that I've just mentioned. Now, what is remarkable about the development of the key shipping lines in this segment within this last 5 years is the very high growth rate that the current number one player in this sector has achieved. And that name is MSC. Now, if you look at what has happened, especially in this battle for that number one position over this last 15-year period, you can see that up until 2021, Maersk was by far the biggest player in this space. But again, if you look at that shift in strategy which started in 2017, Maersk has failed to grow its container ship business since 2017. It has remained stuck at that 4 million TEU level. And that has allowed MSC to overtake them. And right now, the problem is MSC now exceeds Maersk by more than 30% in terms of operating size. And that growth that MSC has achieved is all the more remarkable because it was entirely done organically without any acquisitions. Unlike many of the names in this list here, most of the growth, or a large part of the growth that's been achieved by the other players, including Maersk, including CMA and COSCO, was done through acquisitions. But MSC, throughout this entire period, has not made any major acquisition. So that growth was achieved organically. And what is even more remarkable is the fact that they achieved their fastest growth within this last 5 years, which meant that they have fully capitalized on the super cycle. And right now, although MSC is not publicly listed, you can see how aggressive they continue to be with their planned expansion over the coming 5 years. And they will continue to extend their lead in this market as we move forward. And that very aggressive growth is going to drive the rest of the market, because if you're not growing, then you will remain stagnant, like what Maersk is doing. And I think it was a major strategic failure on the part of Maersk to be unable to pivot away from their focus in logistics, despite the fact that the shipping segment was enjoying supernormal profits during this period. Now, if you are in the Maersk shoes at this point, I think they are at a critical juncture, given that they have clearly failed in executing the new strategy of being a logistics integrator. Now, the key question is, what then do you do? Do you pivot back and try and regain what you've lost on their container shipping side? The problem is, at this point, it is too late for them to catch up. Because within the next 2 to 3 years, they're going to be overtaken by the current number 3 player, which is CMA. And given how tight the shipbuilding market has become in the last 2 years, you cannot grow in the short term, given that the shipyards are fully booked at least until 2028 at this point. Now, again, what's also interesting is to look at the names below the top 3 here. And the problem here is, what do you, if you are one of these players here, including those that are below this top 12 list, what do you do given that the number 1 player has created such a dominant position for themselves at this point? And the clear answer at this point, again, is to invest in more ships. And this has been a perennial problem for this sector, because if you look at the prior history, how the shipping cycles turn about, it always boils down to supply and demand imbalances. And right now, again, if you look at each of these top 12 names in this list, you will see that the order book for each of these companies are getting extremely high, and it continues to grow. Now, the current order book for the container segment has now exceeded 31%. That's an extremely high number, which I think is potentially going to cause a major correction in the market within this next 3 to 4 years. And again, if you look at what each of these names have in terms of their individual order book, all of them, including some of the smaller names here, such as ZIM and PIL, all of them are focusing on growing their scale of operation. And again, for those who choose not to invest, you're going to be left behind, because the rest of the competition is going ahead with their expansion. And the problem here, again, is we're not even at the end of this phase of new expansion, because if you look at the pipeline of new orders that are still coming, we have between now until the end of the year potentially another 1 million TEUs of new capacity that will be added to the order book at this time. Now, again, if you look at the historical growth of the global container ship fleet, you can see that this remains a growing market. And the last 5 years have seen the sharpest growth represented on this graph here, showing the total global capacity in operation. And you can see that very sharp spike within this last few years. Now, pay attention also to the order book, which is the red area on this graph. The order book today is at its highest ever level in TEU terms. But in percentage terms, again, the order book ratio has now risen to 31%. And that is the highest level since 2010. Now, if you compare where the order book ratio was prior to 2009, which was the last global financial crisis, that ratio was significantly higher compared to where we are now. So some might say that 30% or 31% as it stands right now doesn't look as terrible as what it was back in 2008 when it was at its last peak. Now, there's one major difference between 2008 and where we are today. And that is the level of demand. Now, again, if you look at the growth in global container ship capacity within this last 20-year period, the the decade between 2000 and 2010 was its highest growth era. And what was driving that growth was this massive expansion in Chinese exports after 2000, which was when they joined the WTO. So at that point, the market was able to support growth in the 10% and above level. Now, since then, if you look at global throughput for container volumes, that high growth era has been replaced by a much slower level of growth. Because if you look at average annual demand growth since 2010, it now stands at about 4%. And compare that against the era prior to 2009, the average growth at that period was more than 10%. And in order to absorb this current order book of 30%, given that demand is only growing at around 4% at this point, that could potentially take more than 10 years to absorb. And this is the big challenge that the market is facing at this point. And this is coming at a time when there's great uncertainty about future demand growth, especially given the US tariffs that are in place. Unfortunately, there isn't a lot of visibility now, given that we are only at the beginning of this new trade war that the world is facing. Now, this chart is a measure of idle capacity in the market, which is essentially a proxy for excess supply. And again, if you look at what's happened prior to 2009, there were essentially no excess supply in the market. And that was, again, the period driven by very high global trade growth at that point. But that was replaced post 2009 by a significant supply overhang that started in 2009, and it took more than 10 years for that overhang to clear up. And that was, earlier you saw the 60% order book back in 2008. That was the result of that excess supply that was triggered by the high ship orders prior to 2009. And it took them almost a decade to clear out that excess supply in the market. Of course, as we get into the last 5 years, the excess supply has been almost completely removed. Essentially, anything less than 200,000 TEUs in terms of idle supply is full employment. And so you can see it only cleared out starting in 2020. And there was a brief blip in this, driven by the end of the COVID era restrictions. But that very quickly also disappeared once the Red Sea crisis was started. Now, this high employment situation for ships is coming to an end. And you can see, again, this is the new ship deliveries, or rather, the current vessel fleet broken down by age profile. And you can see, at the tail end, obviously, the older ships, the number of the ships built before 2000, their numbers are extremely low at this point. But what's interesting with this is to look at, apart from the extent of new capacity that's been introduced in the last 5 years, and also new capacity that is projected to come in the next 5 years, which is at an extremely high level, especially if you look at 2028. We are going to get a record high level of new ship deliveries in that year. But what's also interesting in this chart is the composition of this new capacity coming in, because most or a large part of this new capacity is coming in the large vessel size sector. 9,000 TEUs and above dominates the profile of the new orders by far. And if you compare that against the smaller feeder sizes, you can see that there has been comparatively very little investment in the smaller ships of 3,000 TEUs and below. And this is potentially going to be a challenge for the market as we move forward. On the one hand, we could potentially have global oversupply driven by this very high level of new ship deliveries in an environment where demand is coming down. But on the other hand, we could also face a shortage in the feeder ship sector, given the relative lack of investment. Now, this is something that we have been tracking very closely, and clearly the market has also realized the potential shortage. And that is why within this last 6 months, we are seeing a resurgence in interest to invest in the smaller sizes. Now, this has some relevance, especially if you look at the current landscape for Malaysian ship owners. Now, I think what is remarkable is I've tracked all of the Malaysian flag container ships in the market over this last 20-year period. And one major feature of this is that the Malaysian flag fleet has been decreasing over this last 20-year period, especially after the exit of MISC from the container ship segment in the early 2010 period. But also at the same time, we've seen the exit of a number of Malaysian names from this sector. The main one, I think, is Johan. But you can see the number of players that remains in this Malaysian shipping market has shrunk. But the other problem also is that Malaysian ship owners have failed to capitalize on the massive super cycle that the sector has enjoyed. Because if you look at the current list of players, there are essentially only 4 Malaysian flag carriers left in the market. And out of these 4 names, there's been only one that has continued to grow. And that one is very clearly MTT. Because MTT is the only one that has invested in new ships over this last period, and they have fully capitalized on the upcycle that the market has enjoyed. The problem is, what about the others? Because very clearly, there is a need to reinvest and renew the fleet, especially if you compare the average age of the Malaysian flagships. And again, if apart from MTT, which right now not only has the largest Malaysian flag fleet, they also have the youngest fleet in the market at this point. And compare that against the average age of the other Malaysian flag owners, which is well over 20 years. The average lifespan of ships on average is about 25 years. So 3 out of the 4 Malaysian flag owners is clearly in need of fleet renewal. And unfortunately, I think most of them have missed the boat this time, given that the fact that shipbuilding prices today is about 30% higher compared to 5 years ago. And even if you are willing to pay the higher price, there is no shipbuilding slots available in the near term. And so this is, I think, a major challenge for the Malaysian flag players at this point. Now, again, what we're seeing right now, as I mentioned, is we are reaching the tail end of this massive earnings cycle that the container shipping companies have been enjoying. And what I've done here is to track the freight rate index, which is the red and orange line here. And again, you can see very clearly the start of the super cycle in 2020, the extent that those freight indices have ended up. And right now, again, we have seen within this last 2 months, especially since the announcement of the new US trade tariffs, a significant correction in the market, partly driven by what's happening in the US. But what I think one of the key problems, again, is the supply overhang that I think, or I believe, is starting to build up. Now, a major inanimate difference between what's happening on the freight side of the market is that the charter side of the market remains extremely high. If you look at the black line on this chart here, which measures the charter rate index in the market, historically, the charter rates and freight rates would have a very high correlation, because very clearly when freight rates are high, the ship owners are able to afford paying higher charter rates. And over a long period of past history, you can see that that correlation has been extremely high, which means that if you measure the ratio of charter rates to freight rates, it tends to hover at around the 100% level, meaning if it's at 100%, then it's perfectly correlated. But you can also see that historically there have been periods where the two indices have diverged. And right now we're seeing the biggest divergence between charter rates and freight rates in the market right now, because charter rates have continued to increase despite the fact that freight rates are coming down quite significantly. And so the difference between charter to freight rate indices right now is at 3 times. Historically, it has never been at this high a gap before. And that this divergence occur is mainly driven by timing issues and supply and demand imbalances within each sector. And that divergence can come out in the container side, which is quite different from the other shipping segments, because there's 2 distinct markets here. There's the freight market and there's the charter market. Unlike the other shipping segments, the freight and the charter rate is essentially the same market. But in the container side, you have 2 separate markets. And when you have imbalances happening at different times in those 2 markets, what this leads to then is this divergence. And right now, as I said, the divergence is at its highest ever level. And this can only lead to 2 things. It means that either charter rates are due for a big correction, or freight rates are due for a massive rebound. Because the shipping lines, why are the shipping lines chasing charters at a time when freight rates are decreasing? Do they know something that the rest of the market doesn't? Unfortunately, I think the first scenario is more likely to happen, meaning that a correction is in line pretty soon. And again, you can see here, this is the average charter rates that container ships of various size segments are earning at this point. If you compare to where we are, even though we have already corrected from the peaks in 2022, right now the average charter rate remains at more than 3 times higher than its historical average. And you can see, again, if you're a charter or if you're a container ship owner and you're chartering your ship out, your returns are significantly higher compared to any time in its prior 50-year history. And so again, those ship owners that have invested in ships at the right time, and again, in this case, if you look at the Malaysian context, there's been only one ship owner that has managed to capitalize on this. They will continue to enjoy higher profits compared to the rest of the market. Now, what I'm trying to do here is to explain why the charter rates have remained that high, despite the fact that the freight market has been correcting, especially since this last 3 months. One key reason is the growth of MSC. You have seen earlier the comparison of the top 12 lines. I have isolated the growth of MSC alone over the same period. And I've broken down the MSC growth in terms of chartered versus owned tonnage. And you can see that MSC's growth came not just from this very aggressive increase in their capacity operated in this last 15 years. It's also come at the time when they have increased by a significant margin the proportion of owned versus chartered tonnage. And again, you can see this illustrated quite clearly in terms of the amount of ship capacity that they have acquired, both from building more new ships, but also from acquiring from the second-hand market. Within this last 5 years, MSC has acquired 460 ships. Just one single buyer alone in the second-hand market. And they have removed close to 1.8 million TEUs from the charter market because these ships are no longer available. And it's all taken by MSC. And so MSC has single-handedly removed close to 20% of the ships available in the charter market. So that has led to a very tight supply situation in the charter market, which is right now reflected in the very high charter rates that we're seeing. Now, there's been also several key drivers of demand that's keeping demand for charter ships elevated at this point, also leading to that very high charter rates that we're seeing. And one of the key things is the growth of the intra-Asian market, which we continue to see. The intra-Asian market has remained highly resilient despite turbulence that we're seeing in the global trade environment. And you can see that in the amount of vessel capacity that's been deployed on all of the key intra-Asia sectors. And the biggest growth this year has been in the North Asia to Southeast Asia trade lane. Part of that also driven by the realignment of carrier alliances. That has driven also a shift towards greater transshipment, especially around Malaysian hubs that's happening this year. I'll show some numbers there. But again, we have seen an increase also in Southeast Asia capacity. If you look at the intra-Southeast Asia capacity, doesn't look remarkably high at this point, but in percentage terms, there's been a significant increase in Southeast Asia transshipment volumes. And that has driven that increase in Southeast Asia capacity as well. But apart from Southeast Asia, which has been a major growth story for this market for this last couple of years, there has also been significant growth in India and Middle East. Part of that growth also driven by what's happening in the Red Sea. Given that prior to the Red Sea crisis, a lot of the ships that's calling between Asia and Europe would pass the Red Sea, and they are able to carry cargo to the Red Sea using their large ships going to Europe. Now that has almost completely disappeared after the Red Sea crisis started because most of these large ships are now bypassing the Suez and taking the longer Cape route, which means that there is still a need to cater to that Red Sea demand, especially if you look at ports around the Jeddah region. They are no longer served by the large ships. Therefore, you need extra capacity to deploy in this intra-Asia sector. That's led to this growth that you're seeing in the Middle East segment. India is the other high growth area that we're seeing. Within this last 2 years, the growth of China-India services in particular has been extremely high. So right now, the good news is intra-Asia volumes remain highly resilient at this point. Now, the other thing that's driving this high demand in the charter market is the diversion of the ships away from the Suez to the Cape route. And this is most clearly illustrated in the Asia-Europe, both North Europe and Mediterranean trade. You can see since the end of 2023, there's been a huge spike in demand for ships on this segment because the ships are right now being diverted around the Cape of Good Hope. And that would require essentially around a 15 to 20% increase in the number of ships needed to run that route. And that translates globally to an excess demand of close to 8% in terms of that incremental vessel demand required to run ships through the Cape. Now that has, again, single-handedly driven this market upwards since the end of 2023. Now, of course, there's a flip side to this because at some point, we do expect that the Red Sea crisis is going to end. And when that ends, there will be a reversal that will happen because this 6 to 8% that is right now being deployed on the Cape route will then come back. And that is going to cause a significant supply overhang in the market because where is the extra 6, 7% going to go? There is no market that can on its own right now absorb that excess supply. Now, of course, the good news is that, or rather, if you're a ship owner, the good news is that the Red Sea crisis doesn't appear to be coming to an end anytime soon. So at this point, for now at least, this is going to keep the market tight for the next couple of months. Now, there's two other regions that has enjoyed super normal growth within this last 2 years, and that two regions is Latin America and Africa. You can see again, the growth of these two regions have been quite consistent throughout most of this last two to 3 years. And it is this growth, intra-Asia, the European routes, and this emerging market routes that has kept demand very high in this market, in this high freight and charter rate environment. Now, the flip side to this is the US, because obviously there is significant turbulence in the American market, especially since the announcement of the new tariffs that started in April this year. Now, you can see when that announcement was made, there was a slight blip, especially in the West Coast supply. There was an immediate reduction, especially on Chinese exports happening at that time. But you can see that given the rolling back of the tariffs by the US administration, most of that supply has come back to the market. And so the Trans-Pacific demand has not diminished because we have essentially maintained all of that capacity within the Trans-Pacific market. And that, again, is helping to keep the market very tight at the moment. And it's not just the Trans-Pacific, the transatlantic trade is also enjoying a similar revival in demand. Now, the problem with all this is all in the past. The new tariffs that start to kick in, starting in August, is going to obviously impact demand in this segment as well, because there is a price to pay when you have such high tariffs being imposed. And eventually, I think there has to be a correction on this side of the market. Now, the good news is that the US, although it's a major market, accounts for just under 23% of global freight capacity. And provided that any shrinkage in US container demand can be kept at less than 10%, and it looks highly likely that that shrinkage will not be more than 10%, that would mean that the global impact on demand is limited to around 2 because again, the US accounts for around 22% of global freight capacity. If that shrinks by 10%, the global impact essentially is capped at around 2%. And that 2% shrinkage in US demand could potentially be offset by growth in other parts of the world, like what we're seeing today. And what's driving this right now is intra-Asia as well as the emerging markets. So there is some glimmer of hope to maintain this very high freight environment, at least in the near term. But as I mentioned, given that the freight capacity to the US have not been cut, despite the turbulence that we're seeing, it is causing significant turbulence in the freight market. And you can see in terms of freight rates, if you're shipping from Asia to the US West Coast at this point, freight rates have come down by more than 60% compared to the peak that we saw in June. Now you can see in June there was, or at the end of May, there was a massive spike in the freight rates, and that was driven by the Geneva Accord between China and US, where they rolled back the very high tariffs on China. So that caused that spike in freight rates. But you can see in the 2 months since we saw that peak at the beginning of June, freight rates have dropped by more than 60%, and the current rate levels is even below where it was in April and May. So that's the price that the carriers are paying for maintaining capacity in a market where demand is starting to drop. And again, for those who have been tracking this market, there's a lot of talk about the carriers being able to show capacity discipline and to maintain capacity to match where demand is. Now, the evidence on this is extremely poor, especially if you look at what's been happening on the US market. And one of the key things that's happening, this is a very busy table, but I just want to highlight, this is one of the things that we track, which is the total capacities in individual trade lanes. And in this case, I'm looking at the Asia to US West Coast trade lane, what each of these shipping line services are providing for each week. And what is interesting, I can just summarize this for you, is what is interesting here is that every orange box here represents a blank sailing. And again, there's been a lot of talk about the ability of shipping lines to blank sailings, which is one of the means of managing supply in this market. And what's interesting is, look at the Gemini columns. The Gemini column is where Maersk and Hapag-Lloyd, the new alliance between these two carriers that started in February this year, what have they been doing? They've been following a zero blank sailing policy, in sharp contrast to the other carriers where they are, to a certain point, managing their supply. In fact, the one that has been most active in managing supply has been MSC. And contrast that to what Maersk and Hapag-Lloyd is doing. Zero effort to even take capacity out, even at times, especially if you look at May and April, at the start of the trade war, when demand from China was down significantly, there were carriers that refused to take capacity out. And this is causing significant turbulence in the market right now. And the result, as you saw earlier, is that significant drop in the freight rates between June until right now. Now, again, if you look at the impact of the new Trump tariffs, it's very difficult right now to make predictions given the lack of visibility, because all of us are right now in uncharted territory at this point. Nobody really knows exactly what the full impact the tariffs will take. This is total US imports in containers over the last 15 or so years, and I've broken down by origin of these imports into the US. The big one, of course, is the red area, which is China. Now, given this uncertainty that we're facing right now, I think the key question is what's going to happen in the next couple of months. There are a few things that I think is interesting based on the evidence that we have seen since the start of not just the current round of tariffs, but since the first round of tariffs that Trump introduced back in 2018. And I think what's going to happen is a continuation of that process that started back in 2018 when Trump introduced higher tariffs against China. The main difference, of course, right now, it's not just China, it's also the rest of the world. The process itself is highly chaotic, but the outcome, I think, is quite predictable. Because if you compare the share of Chinese exports versus the rest of Asia to the US, the Chinese share for a very long period was around 70%. Now, since 2018, that Chinese share has started to drop. And right now, or essentially for these last 6-7 years, after the first round of tariffs were introduced, the Chinese share has dropped from 70% to around 60%. Right now, it's dropped even further to about 55%. But again, even at 55%, the Chinese remains the single largest origin for US imports. And what this shows, again, what's interesting for me is that it does mean that the elasticity of demand for US container cargo is extremely low, meaning that for every dollar increase in price, how much would demand actually drop by? That elasticity measurement is very much less than 1. And the reason I think is fairly simple, because right now what the US is doing is essentially a blanket tariff. It's not a targeted tariff regime that is aimed at reducing their imports. It is essentially a blanket tariff that doesn't result in any change in their trade imbalance, because for most of these containerized imports into the US, there simply isn't any domestic alternatives. So even if you raise prices, you can't reduce the trade imbalance. So at least that is one piece of good news here. But the other thing I think which is interesting is that we are going to continue to see a decoupling of the trade between China and the US. But that decoupling is coming to the benefit of the rest of Asia, especially Southeast Asia. Because Southeast Asia has been the principal gainers in this trade war, and that is evident from the numbers since 2018. Now, within Southeast Asia itself, I think unfortunately, there's only one big gainer here, and that big gainer is clearly Vietnam. Because if you look at the share of Vietnam exports to the US, Vietnam used to only account for about 8% of total US imports back 10 years ago. Right now, that share has risen to about 18%. So there is a 10% gain by one country alone. And you compare that against the rest of ASEAN, unfortunately, the rest of ASEAN failed to capitalize fully on this China-US trade war. And again, if you compare Thailand, Indonesia, Malaysia, although their share has also increased, in the case of Malaysia, the share has gone up from 2% to about 2.5%, a half a percentage point increase. It's still an increase, but nowhere near what Vietnam has managed to achieve at this point. So as a group, I think that the trade war is still a net positive for Southeast Asia. But between Southeast Asia, there are bigger winners and smaller winners. And that, I think, is going to continue as we move forward in the near term. Vietnam remains the clear winner in this case. Now, again, I think the big question that the market has right now is what is going to be the full impact of this tariff war? Now, again, I think despite what the politicians would tell you about how difficult it is to negotiate with the US, what happens in the rest of the world is quite irrelevant, because what is most relevant is what happens to China. As I said, the decoupling between China and US is already in progress, and it's a process that will continue given where the political situation stands. So it's really what happens to the Chinese tariffs that's going to drive trade. Now, for the rest of the world, especially for this part of the world, if you look at Southeast Asia, what difference does it make whether you are at 19% or 20% or 25%? Almost quite irrelevant, especially since these tariff levels are highly likely to be less than what the Chinese tariffs will eventually end up in. Because right now, although the Chinese tariffs is around 30% plus minus, the good news again is that there is no domestic alternatives in the US. And given this very low elasticity in demand, even the drop in China is still fairly limited at this point. Again, if you look at this chart here, the drop in Chinese exports to the US, even during the worst months this year, which was April and May, that drop was limited to only around 25%. So far less drastic than the crash that some analysts were suggesting. Because if you read the headlines, there were people suggesting that the drop in volumes could be as much as 40 to 60%. It didn't come anywhere close to that. The Chinese dropped by about 25% in those 2 months. But essentially, that was made up by gains in the rest of Asia. And again, that big gain we saw came about in Vietnam. But also, if you look at the rest of Southeast Asia, including Malaysia, Malaysia actually gained on a year-on-year basis 22% cargo volume-wise. So again, I think this is a process that will continue in the next months ahead. And these tariff levels, again, the key here is really China. Now, the question then is, what happens given that we now have an extra 90-day extension of the Chinese tariffs? Now, unfortunately, I think we're at the tail end of this Chinese rally, because the peak in shipments, in fact, already took place in July. This is based on arrival date in the US. You can see the July arrivals in the US was a record high, even higher than during the COVID peak. Not many people realize this, but in July, given the front loading that was taking place in the rest of Asia, plus that sharp increase in Chinese shipments post the Switzerland Accord, drove a massive increase in volumes in July. That, I think, represents the peak for this year. I think the next weeks, although the lines are trying to push for another rate increase in anticipation of a new wave of demand, I think it's going to be disappointing given the fact that we have most likely seen the peak for this year. So if I can just spend the last couple of minutes talking about the transshipment scene, because I believe there's also some interest about the upcoming MMC listing. Southeast Asia, as I said, continues to benefit from the growth in volumes. And this has been apparent if you look at transshipment volumes in the 3 key hubs in this region, which is Westport, Tanjung Pelepas and PSA, it continues to grow, but the share between these three hubs have been fluctuating somewhat. And Singapore used to have 100% share of the transshipment market in this region. Right now, that share has dropped to around 65%. And that is due entirely to the growth of the Malaysian hubs, starting with Port Klang in the mid-90s, followed by the growth of Pelepas Port starting from 2000 onwards. But if you look at the main gainers for this year, as I said, the first half volumes remain highly resilient, but you can see there's quite a big difference in terms of growth between these three hubs. Pelepas achieved an abnormally high growth rate of more than 15% versus the global average first half growth was around 5.5%. So Pelepas growth was more than 3 times higher than that global average. Singapore also slightly above average. But look at Westport. Westport failed to capitalize on this. And there's one key reason behind this. Now, what's driving volumes at ports in recent years is the growth of carrier-controlled terminals, or at least equity participation by the carriers in the terminals have been the key driver behind growth in the individual ports. And the key difference, if you look at the Southeast Asia landscape right now, is that PTP has a carrier equity stake by Maersk in this case, and PSA, the Port of Singapore, has been also replicating this because right now they have 7 joint venture terminals with some of the largest shipping lines in the world. And what that does is that it captures a significant chunk of these carriers' volumes within those terminals. That key difference is Westport today does not have any carrier participation. And that is potentially going to drive volumes as we move forward. Now, one last word before I stop here. If you look at the global terminal operator landscape, there is going to be a massive change in this landscape in the next couple of months. And that main change is going to be driven by the sale of Hutchison ports. If you look at the top port operators in the world, the big 4 names in this list has remained very consistent throughout the last 20 years. Below the top 4, those names have been changing quite dramatically. And again, you can see, for example, Malaysia has two players in this list. MMC is right now, I believe, number 15. And they have come out from essentially being a pure domestic operator. But the global environment is dominated by these 4 global players. This is going to change very quickly once the Hutchison port deal comes out. And I believe what is driving the Hutchison deal is the factor that I mentioned before. The fact is carriers now drive port volumes. And I think, Li Ka-shing knows that fairly well, and that's why he's selling out at this point. And once that deal comes about, you will see that landscape is going to change. MSC is going to bring about their dominance from their shipping side also to the port side, because once the MSC Hutchison deal is carried over, MSC jumps to become number 1. And that's going to change that landscape quite dramatically as well. But I will end here, given that my time is limited. I think we have time for discussion following the end of the speaker sessions. All right, thank you very much.